RBC and TD are reading the same market, but it's like they're speaking two completely different languages. Their updated specialty housing report was just released, and RBC and TD, they're not on the same page. And if you're trying to figure out whether to buy, sell, or sit tight in 2025, the drama in these two reports might actually change your whole plan. I'm Linda, one of the Ragona Sisters, and around here, we keep it real. Make sure to like, share, and subscribe so you don't miss what the headlines won't tell you. In today's video, we're breaking down the recent RBC Specialty Housing Report. You don't want to miss this. And a chunk of it differs from the TD's forecast. And we'll touch on what the rest of the year could look like, including 2026. Also, I'll tell you exactly which Canadian cities TD thinks will see actual price growth this year. Now, let's talk about the battle brewing between Canada's two biggest economic giants. TD just upgraded their home sales forecasts, RBC sounding a little bit more cautious, especially in BC and Ontario. Can't blame them. So who's right? TD says home sales across Canada fell very hard in the first half of 2025, down 6.6% overall. But they're betting on a comeback in the second half. Why? Pent-up demand. Sales were flat but steady in April. May sales ticked up by 4%. And if that trend holds, we could see 4.3% growth in the second half of the year in sales. RBC saying, hold up. RBC warns U.S. tariffs could be a dark shadow over housing, predicting this market right now feels like guessing the weather in a hurricane. Everything's shifting by the hour, especially with Trump. And with Ontario and BC, RBC says way too much inventory and not enough buyers. Prices are still sliding, especially for condos in the Greater Toronto area. But here's a twist. TD agrees on some degree. They're not forecasting big price rally in Ontario or BC either. In fact, they expect average prices to fall again in the second half of 2025 in these areas. Just about 0.8%, that's almost flat. But even that tiny drop hides a big story. Let me break it down for you. According to TD, the only reason average prices in Ontario might not crash hard is because the high-end properties, those luxury homes, larger detached properties, they're still selling. So watch out for those average price statistics because they hide a bigger story. Meanwhile, the condo market, it's ice cold. Why? Investors are pulling back, yields are weak, rent gains are flat, and affordability, it's flatlined. Is this all making sense now? In Vancouver, it's a similar vibe. Prices are declining, inventory's ballooning, and buyers have options. Something we haven't seen in many years. That shift in buyer leverage, it's massive. That old blink and it's sold era where you can sell anything including shacks in a week, those days are long gone. Let's talk the Prairies. This is where things get spicy. Both RBC and TD agree that these regions are very different. Calgary, Saskatoon, Regina, prices are expected to climb in the second half of 2025, modestly, but consistently. Why? Because their supply is still tight, and demand, while not booming, is strong enough to keep sellers in control. In fact, TD's betting that the firmest price growth in Canada this year is going to come from the Prairies. Who's surprised? And honestly, that checks out. So what does this mean for next year? TD's calling for stronger growth in 2026. They're projecting 2.5% sales growth and 1.5% in average prices. Fairly optimistic. Modest, but upward. They're betting on improving economy, lower yields, and a bit more stability. Sounds good enough, right? But don't pop the champagne just yet. TD's also warning poor affordability in Ontario and BC will cap that rebound. Prices might rise slightly, but we're not getting any fireworks. And RBC is still very cautious. They're saying that the fundamentals in Ontario and BC are still very weak. High inventory, hesitant buyers, and no room for error. Now let's discuss why TD's betting big on Ottawa's housing plan and why RBC thinks it's way too late. So here's the scoop. Earlier this year, the federal government dropped a massive housing plan. Not sure if you heard about it, but billions for affordable units, incentives for rentals, streamlined zoning. Sounds great, right? But here's the problem. It's not going to be magic. TD's hopeful we'll see results late next year, but RBC, they're not holding their breath. So let's be direct here. RBC's caution is capped by many ongoing variables that we're seeing today because permits take way too long, construction also takes way too long, and labor is still scarce. So even if the plan works, real supply could be years away, and that's not solving our problem today. And in the meantime, prices stay sticky in seller markets and still affordability is a major issue. And one more twist, the federal government is also hinting at public sector job cuts. And if that happens, it's going to hit Ottawa hard.
Learned that cabinet ministers are being told to find significant operational savings over the next 3 years. And unions warn that means job cuts are likely coming.
The Prime Minister promised caps and not cuts. And it definitely feels like the public service workers are going to be bearing the brunt of this.
Letters have been sent out to Prime Minister Mark Carney's cabinet ministers, directing them to come up with a plan by the end of the summer to slash spending. And that has some public servants concerned.
We're starting to talk about it. So far hasn't impacted our department yet, but we're going to find out by the end of August. So the mood is, a little lower.
CTV News has learned ministers must find 7.5% in day-to-day operational savings by the 2026-27 fiscal year, followed by 10% savings in 2027-28 and 15% the year after that.
The government plans on doing this exercise and looking at cost cutting, and they're hoping to have a plan in place by the end of August.
Neighborhoods tied to government jobs, especially around the capital, that could cool very, very fast. Less job security means fewer buyers, more pressure on prices, and that's downward. So yeah, we got a plan trying to boost supply and employment cuts threatening demand. It's not exactly the greatest combination. So what's the takeaway? If you're buying, use your leverage, especially in Ontario or BC. If you're selling, you really need skill. You need strategy and a really good professional. This market isn't bailing anyone out. And if you're investing, play the long game. Focus on strong fundamentals and not just quick flips. And if you're feeling confused, trust me, you're not alone. TD's betting on a soft rebound led by the Prairies, helped by really good policy. RBC saying, don't forget the risks. RBC's forecast next year could bring a slow rebuilding of confidence in the housing market as tariff tensions cool and some of that earlier uncertainty fades. That should help boost demand across the board, but with job growth still lagging, any real recovery is likely to be gradual, not explosive, and that makes sense. As always, if you're in the GTA and you need assistance, please reach out. We'll help you make sense of all this chaos. And next week, we're digging into how immigration slowdowns are reshaping the rental market and what investors really need to watch out for. So, who do you think is right, RBC or TD? Which one do you see being our future? Love to hear your comments. I read all of them. So, that's it for us today. Thanks for watching, and we'll see you in the next one.